everyone. Thank you for joining us today. My name is Julie Busby. I am the founder of Busby Group. We are a top real estate team at Compass in Chicago. We are all things residential real estate in Chicago. From time to time, I will bring in a guest to share with our database and our friends, clients, family, et cetera, to share what's going on in the marketplace. And I thought this was a pivotal time to do so. I brought in Chad Lubben. And Chad, I wanted you to introduce yourself, more about yourself, and then we'll get into what we wanted to chat about today.
Yeah, I'm Chad Lubben. I'm with CrossCountry Mortgage. I have the privilege of working with Julie and her team a lot. Julie and I have known each other over 10 years now. I've known you about as long as I've known my wife. So
This is crazy.
we've worked together for a long time. I just celebrated last Monday 20 years in mortgages. So I've seen a lot of markets, and this is certainly one of the most interesting, but certainly things we've been through in the past. And I think there's a move to normalization. And I know that's what we're going to talk about today. So just honored that you have me here and excited to talk about the opportunities in real estate.
Thank you. I love that you touched on your background and 20 years. I am also 20 years into this industry. I know we both started when we were like 5 years old, and and then yes, and then halfway through our career, we met each other, and it's been wonderful
Right.
because it's great to have another seasoned professional providing excellent advice to our clients. And like Chad said, this is a pivotal time where there's a lot of uncertainty. People are curious what's going on. They've seen a little bit of volatility in rates and in the market. And we just wanted to share insider tips and what we're seeing. And quite honestly, we're finding it's still a wonderful time to buy. It's still a great marketplace, and rates are actually still very reasonable considering the long history of rates. So we wanted to touch on that. In fact, Chad, I don't know if you've heard this. I've had a few clients say that they want to rent instead of buy, and sit on the sidelines and see what happens. And then we start the rental search, and we're finding that rentals have gone up 20, 30%. And then we readjust and say, okay, wait a minute, maybe this doesn't make sense. And I've been having a lot of my clients reach out to you because what I love about you and your team is you see the full picture of what financially makes sense for clients and what what you might see on the horizon and what makes sense for them. So I know we've been having a few of these conversations with clients, and I thought let's share it with more people. So I wanted to see what your take is on that and what you're advising to clients right now.
Yeah. And if you could let me share my screen, I'll show you some calculations. I know when I talk numbers, sometimes it doesn't sink in when I hear people talking numbers. I like to show people numbers so they can see the mathematics behind it and do the calculation themselves and see why it makes sense.
Perfect. I think I gave you capability.
You did. So first of all, I did a really nice exercise for myself. I put 2020, 2021 on a piece of paper. I circled it 3 times, and then I crossed it out and I put RIP. Right. So I think I had a recent high school reunion. It's like high school athletes talking about how good they used to be. I'm like, that was 20 years ago. It
Yeah,
doesn't matter,
man,
right?
move on. Yeah.
Let's move on, right?
Yeah.
That's kind of the same with this market. Like, it was fictitious. I won't get political, and I don't think it needs to be a political statement. But I just think we spent too much money. There is this influx of money pumped into our economy, and our sector, which is the real estate sector, benefited from us the most. Like, I've seen clients sell their home for record prices and make a killing. I've seen myself in the mortgages. I had record years in 2021. I know your team did amazing numbers, and that's all great. But it wasn't normal, and it's not ever going to be normal. And I don't ever think anything should be compared to it. It's gone. It's over with. When you look back to the numbers of 19, 18, 17, you and I have been doing this long enough. We know that's a normal and a very good market. Right. And
Right.
let's not kid ourselves that this still isn't a great market. Right. When we look back take out 2020, take out 2021. This is still right on pace and a little bit better than 2019 was, which was a really good market as well. So
Right.
I think it's really important to look at that and to not factor anything that happened during 2020 and 2021 into any of your planning. I invest in real estate. I don't take it into consideration. I invest in the stock market. I don't take any of that into consideration. I look at normal markets, and we're just returning to a normal market. Would you agree?
Totally agreed.
Yeah.
Yes. Having the same
So
conversation with my clients. Yes.
yeah, so let's not expect what's happened, and let's move on to 1.9915% year interest rates. Probably shouldn't have never happened, and I don't
Right.
know if they ever will happen again. I'll never say never, but I just don't know if that's going to come back, right? So you can't look back to high school and your quarterback or your cheerleading days, say, I wish I would have done this too long ago, move on from
Right.
it. So that's what I would like
Yes.
to do today. So if we look at this, let's say Julie and I kind of agreed before this at about 700,000 purchase price is about the average purchase price her and I worked with. That doesn't mean that's where you're buying at. We certainly do deals bigger than that. We certainly do deals smaller than that, and we'll take on anything in between that. My normal down payment on 700,000 is, can you see my screen okay?
We can. Yes.
Yep. 700,000 is actually 10%. So everyone thinks you have to put 20% down. You don't. We do a ton of 10% down purchases, really up to about that 750, 800. Some people put 20% down, some people put 5% down, but that's about our average. So that's a $70,000 initial investment.
I wanted to chime in there real quick because we just helped another client recently and they ended up putting 5% down and they didn't realize that was an option. So I think that's really key that you did say that.
Yeah,
Sorry to
so
interrupt.
I'm just calculating really quick. And if you need any clarification on all these calculations, call me to go over what closing costs are, but it's going to be about $12,000 at that price, give or take. Okay. So our initial investment in the property, let's total this up, is $82,000, right? So that's your investment. That's your investment in the property. Your initial investment is $82,000. Now, the great thing with real estate is you get to leverage if you get a mortgage. And if you haven't heard the term leverage, it's saying, hey, I'm going to borrow the bank's money, but I'm going to get the return on the entire asset. So CoreLogic just came out and said about 4.5% appreciation from July 2022 to July 2023. Now realize that's a forecast. That doesn't mean that's going to happen. That's what they're forecasting.
Sure.
And they were dead on last year, right?
Wow.
And when they went July 2020 to July 2021, they were conservative, but they were the closest.
Wow.
So no offense to any of the National Association of Realtors, or there's several other people that forecast this
Forecasters.
number. I've just found that to be the one that I latch on to and I find to be pretty accurate when you look back at it. So I like following CoreLogic. They said 4.5%. So if we get 4.5% from 2022 to 2023, the return on your $700,000 home is $31,500. That's what you made in that year in equity. Cool. So when
Wonderful.
you divide that by we said 70 or $82,000 in, right, with closing costs, we get a 38% return on our money. Nuts.
Wow.
Now
It is nuts. Right.
I'll have some people argue with me like, what about the monthly payments? And my rebuttal to them always is, well, what do you think you're paying when you rent? You're just paying your landlord's monthly payments.
Right.
And sometimes they'll say, well, hey, I'm not paying all their principal, I bet. And I say, I bet you are sometimes, or you might not be, but I guarantee you, you're paying their interest, their assessments if they have them, and their property taxes, and probably some of their maintenance.
Agreed.
Now we can debate whether you're paying their principal down, and that's their cash flow, right? So
Right.
that's debatable. And if you're not paying all these things, your landlord's a terrible business person because, and that's just the truth. I know you've had properties, I've had properties. My tenants have paid my mortgage for me, and I've repped all the
Right.
benefits of the equity gained, of some cash flow on some of the properties and it's just that's what you're paying for, and that's why people invest in real estate. So don't let your landlord do that for you. You should be doing this yourself.
Great.
Any
Agreed.
questions on that ROI? Any statements, Julie?
Love it. No, I just love the way your mind works. I work with a lot of analytical clients, and I love this. So it's perfect. Thank you.
Cool. So now let's get into something for those analytical clients. Let's get into something a little more detailed. And this is a
Perfect.
tool with some pretty graphs and charts and things that speak to me. Now, this is estimates, and I can run this for anybody that wants to see this specific to them. But this is a $700,000 home. We're using locally in Cook County about 14,700. That's about a 2.1% tax amount.
Yep.
That's a little different in each neighborhood and each area. If you're buying in the city of Chicago or the suburbs, this is the average of Chicagoland. Keep in mind. Okay, I'm going to knock this down, but homeowners insurance has got more expensive. Property taxes have increased more than 2% per year, so I'm going to bump this up to 4%. Right? I'm going to. What do you think an HOA is at a $700,000 condo? On
Uh,
average.
on average, let's call it 400
Okay, I was going to say 500.
or 450. Yeah.
Yes. Cool. Julie is, when she goes to sell you this house, is going to charge you 6%. Is that, am I setting your commission for you, Julie?
That works. Yes.
Okay, cool. If you get a loan, right, let's do the 10% down, 630. Okay. On average, interest rates are about 5.5%, right? They change each and every day. If you put 10% down, you're going to have a little mortgage insurance. And then, like I said, our closing costs are going to be about $12,050. Now, let's say the average time to own a home, Chicagoland is very transitional. It's about 5.5 years is what I get from most of my agents. They say it's about 5.5 to 7 years. Julie, would you agree?
Yes.
Okay. Historical appreciation in Chicagoland is 3.89. Look, it factored it right in for me, so you don't have to just take my word from it. This is an input directly from CoreLogic. Okay. And they're
Love
saying
it.
6.5. Okay. Now, let's say you at this price point, I see most people being married couples or two couples together, making about, I think 20, I'll use 24% just for the sake of being conservative, but it's usually somewhere right in between here. They're making about 170 to up to 300,000. So I'll use this number. They're taking a standard deduction on their taxes. Okay. So check out the results. And this is me doing it on the fly. This is no like preparation of the numbers. Okay. If you buy a home for 700,000 and you stay in it for 5.5 years, and you get 465 appreciation, that property in 5.5 years is going to be about $900,000. Okay. Now, remember, you're locking in your loan 630. You're paying down your mortgage, not your landlord. So that's building equity through principal reduction, it's called, right? So
Right.
you're paying down your mortgage, right? You're also getting some tax benefits here, okay, at this tax bracket by not doing the standard deduction and itemizing and taking the mortgage interest deduction. So you got to factor that in. Okay. The cost to sell the home is going to be about $54,000. Right. Now, there probably isn't too much maintenance in a condo, and I didn't factor in any maintenance. So take that into consideration, and I could plug something else in here. But your net gain by buying instead of selling over 5.5 years is $270,500.
Incredible. And that's at today's rates
That's
for
today's rates, today's
fixed,
prices, right?
right?
Now, people will debate with me and say, well, we're entering into a recession and property values are going to go backwards. I actually disagree. I think property values will continue to go up incrementally, somewhere between 3 and 5%. This kind of fits within that at 4.5%, what CoreLogic forecasted.
No, I agree. I know you and I have chatted about recessions historically, and historically, the values don't tend to go down, other than the financial crisis, which is a whole different ball game.
Right.
During recessions, historically, prices actually tend to go up, and I think a 3% is about a healthy, normal marketplace. Like you said, we're getting back to a normal marketplace. About
Right.
3% to 5% is your normal appreciation.
Yeah, and anyone that says like, "Hey, I don't think real estate's a good investment." Well, across the country, we just received 40%, over 40% between 2020 and 2021. Remember, I said take that and throw that out, right?
Right.
But also this year, it's looking about 4 to 4.5, up to 5% that we're going to get by the time the year is done, right? Now, I invest heavily in the stock market. I got similar returns in the stock market from 2020 and 2021. But guess
Right.
what? I'm not positive this year. I'm way negative,
Right.
right?
Right.
So this is a third good year in a row where it didn't pull back, and it didn't pull backwards. And both Julie and I think it's not going backwards.
Right.
And that's simple economics. There's more
Right.
population growth and more households being formed through the millennials graduating to have families, moving out of smaller homes, getting into bigger homes, increasing their family. The supply of real estate just still hasn't caught up with that population growth.
Agreed. Agreed.
Cool.
We're still, yes, I completely agree. We're still historically low on supply. So I do think that that is protecting our values as well.
Now,
So yes.
here is the truth of what's happening. And you can talk to this a little bit. And I know you and I talked about a little bit about this before we prepped for this call. With the return to normalization is a shift of moving a little bit more to, I don't want to call it a buyer's market. I want to call it that the pendulum has shifted a little bit from being so heavily favored to the seller to being a little bit back to normal, maybe not all the way of what you and I are used to, but it's returning to there. So why don't you talk about that? And then I'll talk about my tools that can help a buyer.
Absolutely. Yes. No, I absolutely agree that the pendulum is definitely swinging down some to be more of a steady, healthy marketplace, not so strong on the seller side. It's making it a healthy marketplace for everyone, quite honestly. And what's interesting is I know, Chad, you and I have done a few transactions like this where this is also an opportunity where maybe you can ask the seller to help contribute towards your um cost to potentially buy down your rate. So even though Chad just presented that rates are in the fives, low to mid fives right now, which is still historically low. But let's say you originally started shopping for a home in the threes earlier this year, and now the 5% is scaring you. What's really neat are there are options to help buy down that rate. And Chad's been using a lot of great tools, and we've been partnering together on this. One, we've had some great success of having sellers contribute towards buying down that rate instead of saying, "Hey, take 3% off your purchase price. Why don't you take that 3% and help contribute that to me buying down the my rate?" And Chad, I'll let you explain that and what that means to the consumer over the life of their loan.
Gosh, I don't think I could have explained it better than myself. Thanks for
Oh, well,
taking
good.
that. I mean, yeah, we're looking at 700,000 in purchase price. Keeping with the 10% down theme, that's a loan amount of 630,000. Current rates we said are about 5.5. This would just simply buy down the interest rate for the first year to 3.5%. Then the second year, and that payment would be $2,898 or $2,828, right? You can see if you take that off of this, I'll just do the equation here to save time. This minus this equals this. So it's a $748 savings for the first full year.
Monthly.
Monthly, thank you. Monthly,
Amazing. Yes.
right? So the hope is here, and what I think is we're not going to go into an election year of 2024 and rates are going to be this high. I think there'll be the recession will start. Don't get scared by the word recession. There's opportunities in recession, and we're not going to have a recession where real estate values drop. They'll stabilize and stay the same or incrementally increase. Julie and I think they will incrementally increase. So the hope is while you're saving this for the first year, by 2024, we're refinancing. Well, if that doesn't happen in year 2, we're at 4.5%, right? And that bumps up the payment a little bit, but you can still see that there's savings of this, right? Minus this. So you have that savings of $384 for the entire second year per month, like Julie said, right? And then it would normalize to a $3,577 monthly payment. If I'm totally wrong and rates don't cycle over this, you're protected by having this rate always locked in. And candidly, you're on a very average interest rate over the last 30 years. In fact, 5.5 has been deemed low. Really, any point up until 2019, that was a pretty attractive interest rate, right?
So I went on that note. I wanted to point out you and I again have been doing this 20 years. And when you started 20 years ago, where were rates?
Well, when I did my first loan application, it was around 10.5%. And by my 6th month, it was in the 9s, and we were ecstatic that it wasn't double digits. And I remember my sales manager saying, "You're never going to see this again, single digit interest rates." Right?
So I just wanted to point that out. I mean, we have, Chad and I have been through recessions. We've been through financial crisis. We've been through a lot in this career. And it's, these rates are still very historically low. And like you said, average, which is
Right.
phenomenal. Phenomenal.
So the cool thing is let Julie and I negotiate this with the seller,
Yes.
right? What Julie's doing is she's going and asking them, hey, you don't need to cut your price maybe so much, or we can negotiate the price and work on this credit and somehow get a deal off the list price. But maybe it's more important to you, the buyer, to have lower monthly payments than to have that price lower, because it will impact your monthly payments more having a lower interest rate than a lower price point. So what Julie and I is just go to the seller and say, hey, we need this credit, right? And we need monthly payment relief for our buyers more than you hacking down the price. Or Julie, you can talk about how you negotiate this.
Yeah. I mean, there's multiple ways to negotiate. It depends on the property itself, but I can say we've had great success at this. Whether it's, even if it's a competitive situation, we've still been able to get the seller to contribute to buy down. So
Awesome.
know that even if there are multiple offers, we've had success at doing this. And then especially if if it is a home that's maybe been on the market for 45, 60 days, then it's absolutely, we can work on the price and getting a credit towards this. So, I mean, this is just a great opportunity.
So I'm keeping a client late by 4 minutes. Is there anything else that you need me to add?
No, this is fantastic. I appreciate your time. And we'll make sure everyone out there has your information to ask any supplemental questions. And again, thank you. And I'm sure I'll talk to you very soon.
It was an honor being on. And guys, remember, this is normal. We're moving to a normal market. There's tools, there are options, but I don't think there's a better and more important time to work with experts like Julie and her team. I can truly say I work with a lot of realtors out there. there are very few that are as good as her and her team, that are experts, that are great negotiators, that are patient, that are well received in the market. Keep in mind, this is still a relationship based business behind the scenes. Julie makes great relationships with the other realtors that have these properties. And I've just seen her be able to get into a lot of properties and negotiate on a lot of deals that other realtors haven't been. So make sure you're using experts like Julie.
Well, right back at you. One of our favorite things is your team. You guys are excellent at helping the client look at the full picture. And every day these rates are changing, and you are excellent at saying this is the time to do a 30-year fix, this is the time to do an arm, this is the time to negotiate a buy down. And we strategize and work together. And we love that about you and your team. So thank you for your help,
It's
your
always an honor
ongoing
working
support.
with you guys. Thanks for having me on
Yes.
today.
Talk to you soon.
Bye.
Bye.